Tech stocks are out. And with everyone dumping their positions, it's a good time to research the sector. Why? Because there are high-quality companies that are now trading at a discount. And eBay is one business that currently looks like it's entered value territory. Today's video will explain what makes eBay an attractive investment and why I think it may even outperform bigger, more popular competitors like Amazon and Etsy. Here we go. What does eBay do? eBay is an online auction house and e-commerce site. Founded in 1995, it's often considered one of the rare .com bubble success stories. And today, eBay is a multinational online retailer valued at more than $21 billion. Despite being an established business with a track record of long-term success, eBay has always played second fiddle to competitors like Amazon. Even newer e-commerce platforms like Etsy and Mercado Libre overshadow eBay, at least when it comes to Wall Street interest and financial news coverage. While this is bad for short-term traders looking for rapid growth, it has made eBay something of a steady valued dividend stock. But more on that in a moment. eBay fundamental analysis. eBay has lagged the S&P 500 over the past 10 years. The company has only delivered an average annual total return of 7.25% versus the S&P 500's 12.55%. This is disappointing. But there are a few upsides that, in my opinion, could help boost eBay's stock in the long run. The first advantage is eBay's low valuation and hidden moats. Right now, eBay trades at a PE ratio of just 9.79. This valuation is only slightly higher than cigarette maker Altria Group, a company that's constantly facing legal trouble and societal headwinds. Considering the fact that most e-commerce tech stocks trade at valuations well above the PE 50 range, Amazon is valued at 76.62, Mercado Libre is valued at 97.87, Chewy is valued at 3,103.39, I think eBay is undervalued. Especially considering some of eBay's moat-like advantages. For starters, eBay facilitates the trading of collectibles and luxury goods. Two sectors that Amazon really struggles with. If you want to buy a back issue of Avengers number 182, I picked a random comic book for this example, you can get the physical copy on eBay. Whereas Amazon only sells a digital edition. Likewise, eBay is a huge marketplace for second-hand and vintage luxury goods. If you want to buy an authenticity-verified Rolex, discontinued Hermes scarf, or vintage McDonald's ashtray, you use eBay. Even eBay's used book selection is cheaper and more diverse than Amazon's. I know this is anecdotal, but I buy all my paperbacks from eBay instead of Amazon, because they're generally less expensive and include free shipping. Management recognizes eBay's advantage in the collectible and second-hand market. And they are actually doubling down on both sectors. eBay recently opened a 31,000 square foot vault to house high-priced trading cards and other luxury goods. Management even believes that the eBay vault will expand to hold over $3 billion in luxury items, making it one of the largest stores of non-governmental assets in the world. These advantages have allowed the company to remain profitable, and eBay has even initiated a dividend. Something which is also beneficial for shareholders. eBay started paying a dividend in 2019 and has grown their payout every year since then. Additionally, these payout raises are huge. In 2022, eBay boosted their dividend from 18 cents per quarter to 22 cents per quarter, a 22% increase. A similar thing happened from 2020 to 2021, when eBay bumped their dividend from 16 cents per quarter to 18 cents, or 12.5%. The stock currently yields 2.19%, with a payout ratio of just 20.54%. So, eBay has plenty of room for future growth. I also think the eBay dividend is smart, because it forces the company to reward shareholders in cash, rather than focusing on buybacks or questionable forms of innovation. Facebook, in contrast, bought back $25 billion of their stock right near its peak, while also funneling money into their disastrous metaverse project. As long as eBay continues to succeed in their niche and raise dividends, this could be a potentially great long-term dividend stock. Which leads into the final point, eBay's low expectations. eBay versus Amazon, Etsy, etc. As mentioned earlier, eBay trades at a PE ratio of 9.79. Meanwhile, Amazon trades at a PE of 76.62. And Etsy is valued at a PE of 31.36. eBay is facing the proverbial one-foot hurdle. As long as the company does okay, it should see some PE expansion, leading to an increase in share price. As an example, eBay currently has an earnings per share of $4.11. Hypothetically, The stock being revalued at a PE of 12 would bump shares from $40.17 to $49.32. Meanwhile, a richly valued business like Amazon or Etsy needs to clear a lot of hurdles just to maintain its growth projections. eBay, on the other hand, faces no expectations. Lastly, while there are other publicly traded marketplaces for collectibles and luxury goods, most of them are not profitable. The Real, a second-hand marketplace for designer clothes and high-end watches, has seen its share price decline from over $28, down to just $1.10. Private businesses like stocks are harder to assess. But from what I cobbled together after reviewing stocks' private equity funding, the company is significantly smaller than eBay, less than 1/20th the size, and even that valuation seems generous. Conclusion: I've never reviewed a tech stock before, because most companies in this space are extremely overvalued and rarely deliver good long-term returns. For every runaway success story where a far-sighted investor turned $500 into $500,000 buying Amazon stock, there are 100 stories swept under the rug where someone bought DocuSign at $300 per share, or lost everything in 360 networks. eBay is interesting because it's an established and profitable company that's trading at an extremely low valuation. And it pays a recently initiated but consistently growing dividend. I'm definitely adding eBay to my investment watch list. Disclaimer: this video is for entertainment purposes only. It is not financial advice. Always do your own research. Thanks for watching and have a great day.